Good morning. It's Wednesday, September 21st. I'm Steve Rand. This is Todd Graff, and this is the Gold Spot.
Yeah, so everybody's watching what the Federal Reserve is going to be doing today. The chairman of the Federal Reserve, Jerome Powell, he's going to be, more than likely, he's going to be raising interest rates today, but he had a speech recently where he mentioned that he's going to be following the 1980s playbook as far as interest rates and everything. So can you tell us a little bit about that?
Yeah, you probably hear a lot of people, probably people our parents' age, that talk about what happened in 1980 and when interest rates were aggressively raised by Volcker up to as much as 16.5% or slightly above that. And obviously the majority of us don't really remember anything like that or don't have any reference of what that would really mean in today's economy. But at that time, we're talking about some enormous moves that we're taking to be able to try to get us out of some deep trouble we were in economically. Inflation was running away, and we saw them go in and raise interest rates by sometimes more than a whole point at a time. Now, Fed Chairman Powell is now saying that they'll take steps, any steps necessary to avoid recession, which means they could even be raising rates over 1% at a time now, and it's going to create obviously some very difficult time than we're used to. They're also saying that unemployment could get well over 5% this time, which is just unimaginable compared to what we've experienced over the last several years. My concern is, what is that going to do to our economy now compared to what it did in the past? So we know what it did in the past. We saw the price of precious metals obviously go to some all-time highs at that time. What would you expect it to happen right now?
Yeah, I mean, the country is definitely a different place than it was 40 years ago. And I think what people need to do is think about this. So what they're doing is they're raising interest rates. That's going to affect debt more than anything. And right now in our country, I mean, we have more debt than we've ever had. We're at record debt under every category, as far as mortgages, student loans, credit card debt, corporate debt. It goes on and on. So any changes in interest rates right now, it might seem small what they're doing, 75 basis points or 100 basis points, but that has a huge effect on individual people's debt and their situation. So I think what we could see is a perfect storm of a debt crisis, and if unemployment is increasing, people aren't going to be able to pay their higher mortgage payments as well. So there's a lot of different factors. And I think it just goes to show, the Federal Reserve isn't going to be able to come up with a perfect combination to get us out of this situation.
No, they're backed into a corner for sure. And then when you see whatever happens, whenever they raise rates, you see what happens. The stock market suffers greatly. We're seeing that right now, getting tons of calls from people that are looking to move money around because they're worried about what their retirement's going to be looking like in the next several years. And a lot of people I've talked to have said 2008 was bad, but I see this as being much worse. And then you look at what's going to happen to the housing market when interest rates go up. Look what's happened in the last year as that market's cooled off. You start raising rates aggressively, and I'm not talking we're going to necessarily go to 16.5% like we saw back then, but certainly could get a lot more aggressive and could keep a lot more people out of the market. So there's a lot of things that are on the horizon. We don't know exactly how it's going to play out, but certainly we know that it's not going to be what we've been seeing over the last several years for sure. Thanks for joining us, and we'll see you next week on the Gold Spot.